All right. Good afternoon, everyone. At this session, I'm Pete Weber. I'm the Chief Life Actuary at the Ohio Department of Insurance. I'm going to update the GOES project, Generator of Economic Scenarios. Then Amy Fitzpatrick, Actuary at the NAIC, will provide update and background on the Valuation Manual section VM22. And lastly, Fred Anderson, Chief Life Actuary at the Minnesota Department, will give us an update on the asset adequacy testing of the reinsurance, the new guideline AG 55. So first off, generator of economic scenarios. First question we have to ask is, well, what is an economic scenario? Well, it's a projection of financial variables or economic variables, elements of the economy like treasury rates, equity returns, bond fund returns, those sorts of things that companies will need to use to perform reserve valuation and capital measurements. So two pieces there. A projection. So a projection can either be deterministic, which just simply means it's based on a formula, sort of predetermined. A very common deterministic scenario is a level interest scenario where you would be looking at treasury rates that just start at a point at a valuation date and remain level for the entire projection period. That's one of the New York 7. You might have heard use of the New York 7 interest rate scenarios. There's a level, there's like a pop-up and remain level, there's an up and down, down and up. There's a combination of different treasury rate movements over the projection period that provides some insight, particularly in kind of how the company's block of business will perform when rates do those different kind of take those different future forms. It's not great for actually determining the reserves, but does provide some insight to regulators and the companies as well to say, well, is my model robust enough? Is it really performing and producing results that I kind of expect to do? So that's where that's valuable. But like I said, they're not as useful really in kind of today's the way reserves and capital are determined today, to just use a series of deterministic scenarios. But then there's the other type of scenario is a stochastic scenario, which is what the GOES is. It's a generator of economic scenarios that is producing something like you see on the screen here. As you can see, we put together a slide that looks at what rates, what the 20-year U.S. Treasury rate looked like beginning in about 2017, and how it moved over time until, I think this was probably June of 25 this year. And then we plugged in the projected interest scenario from the GOES. It kind of tacks that on, and you can see, that's what we expect potentially. That's kind of how rates behave. They move somewhat randomly, but based on events, I guess, in the economy. Now, a single stochastic scenario isn't necessarily terribly valuable, but if you run thousands of them and you provide a nice wide range of where the interest rates and equity markets and bond returns, kind of how they behave, then you can have a company run those thousands or 10,000 scenarios, say, and look at their results at the end of the projection and say, wow, what's my surplus position look like? If you've got a nice, strong surplus position at the end of that, well, then maybe you don't need any additional reserves and capital level for that particular scenario. But if you run thousands of them, the idea is to take the ending results and order them from best results to worst results, and really focus on, well, okay, what's going on down in those worst results? If all those worst results are still positive, well, clearly that's a good thing, and we don't have too much concern with that. But more often you have, especially with the long duration and the types of risks and all the economic risks that insurance companies are really taking on, it's kind of point. You want to really focus on, for reserves down, if you organize them and you're kind of looking for sort of an 85th-ish percentile worst, and for capital, you're kind of trying to target a 95th-ish percentile. Now, there's different kind of ways you get to that, but that's sort of the general idea. So to the extent that a company would be in a negative surplus position in any of those two, they would have to either post additional reserves, or their capital requirement for some of the products we're going to talk about, the life products. There's expectation that that's your level of interest rate risk or C3 risk that this scenario generator is designed to be used in. So there's the graph, and this, like I said, this is a single scenario for the 20-year U.S. Treasury yield. The GOES generator produces much more than that. It produces returns at the different tenors, or investment durations, I guess you could think of it as, for 90-day, 1 year, 10-year, all 30-year, and also for equity returns, and like I said, bond fund returns over that period. Sorry, this is the button I need. All right, so why do we need a scenario generator? Well, over the past several years, the NAIC and the standard valuation law has been evolving to use more of a principle-based approach, and you probably have heard of PBR reserves and principle-based approaches to capital. The idea is to do exactly that, where you go back 30 years, you assumed a mortality rate, you assumed an interest rate, very conservative mortality, conservative interest rate, and you used a formula, you plugged it into a spreadsheet, and essentially came up with, well, here's the value of my benefits that I expect to pay in the future based on the probability that could happen, discounted at an interest rate, and there's your reserve. And that worked well for many years when products were fairly simple, whole life and term and simple annuities. But as you kind of got into the 80s and 90s, universal life, it became very difficult to apply that kind of simple approach to those products, and variable annuities came along and other annuity guarantees come along. It became clear that, hey, that approach is really just not sufficient enough. We need to start looking at this idea of having companies build models to project their business and see, under a wide range of scenarios, kind of where that interest rate risk, kind of where it's identified in all of those 1,000 scenarios, again, as I described as you order them. So here just kind of, again, lays out the scenarios that are produced, the U.S. Treasuries, equities, again, S&P 500, say, or large cap, funds or whatnot, and then, bond fund scenarios. And at this point, as of, I think, the last summer meeting, we have adopted that sort of an approach for life insurance, which was actually adopted back in finally adopted around 17-ish. Variable annuities goes back much further in time than that, because you can imagine as you're making guarantees on how your separate account funds are going to perform if they're invested in the equity markets, it can be very difficult to apply a simple formula to how you ought to be calculating the expectation of benefits and then discounting it. That was really the first principle-based approach that was put into place. And then just this last summer, the VA VM22 that Amy will talk about, that was finally adopted. So these are 3 huge product areas that have adopted this principle-based approach that will be using this the GOES, generative economic scenarios. Kind of completing this slide, the reserve standards, clearly I hit on the 3 VM sections because those are critical. You will use the GOES to determine reserves for those products. Asset adequacy is sort of a layered on analysis where the company, opining actuary, kind of has to look at the whole of the company and looks at the products kind of generating in aggregate that their assets are sufficient to meet their liabilities, meet their obligation, not only at the end of a projection period, but kind of like at points along the way. So that's a critical part of that. Risk-based capital, there is no sort of projection concept for life insurance, but for VA, again, that has existed for many years, and we are introducing the non-variable annuities. They actually use a little different approach with factor-based approach, but there are scenarios, but not, I don't believe the GOES, it's kind of still being worked out how that will apply. And again, companies, I guess the asset adequacy and the own risk solvency assessment, those are clearly projections that are done, but there's really, it's kind of up to the company to determine what scenarios are appropriate for doing that sort of analysis. All right, and this slide here goes into the project history of GOES, and I guess it kind of goes, you could say it goes back to around 2017-ish, when the American Academy of Actuaries had notified LATIF that they did not want to, they didn't have the right resources or really the desire to continue to maintain the current generator. So yeah, stepping back a second, way back in the 90s, when VA started, and even asset adequacy, the use of scenarios, this concept, the Academy stepped up and volunteers developed a generator that kind of would produce these scenario sets and would be used, and they were used for years and years, developed by volunteers, and there wasn't really a method or a system for kind of always updating that or reacting to things that changed that where it really needed to. I think the Academy also felt that there might be some risk to the Academy if something wasn't quite up to snuff with their generator. So they're like, hey, we really got to get out of this. So at that point, even right after the kind of coincident with that, it was the Financial Stability Task Force noted a potential deficiency that generator was not producing enough low for long scenarios. So what's a low for long scenario? Well, as it sounds, you have interest rates that are down low, and they kind of remain that for a long period of time. The Academy generator was really not robust enough to provide that look, that kind of to assess that sort of risk in the reserve determination. So kind of after that, then the NAIC put out an RFP. They had several get provided. They reviewed them. There was a whole open process. They settled on Conning is the vendor that produces the GOES scenario. And kind of after that, they sort of took an off-the-shelf, okay, let's build some scenarios and run a field test. Now, it probably wasn't quite that simple, but they did some effort and got the first field test underway. And what was kind of difficult is you can kind of see in this, it's pretty valuable that this slide shows where we were with interest rates at that point. That is a very historically low interest point in interest rates. And I would argue it really kind of slowed down the process a little bit because we were trying to build scenarios from a starting point that was way like in the tail. It was a very low point, and it ended up producing a lot of negative rates. It produced a lot of deep negative rates, and a lot of, I think, regulators in industry, when they looked at the field test results, like this really doesn't make sense to us. We need to really revisit the calibration of this. So a lot of work was done, a lot of back and forth. You get to the second field test, we addressed a lot of those issues. And then, in fact, there was still some work after that second field test. We never really did have a final third field test, but I think regulators finally got to a point where they were comfortable with, yes, we've got this to a point where we can use it, and we should go ahead and adopt it. So that's where we got to just this year. Let's see. Oops. All right, this slide talks about the benefits of GOES, key benefits, and it's sort of like I said, the prior generator was developed by volunteers. I mean, it was a decent generator. It lasted a long time, but at the end of the day, it's still you were relying on another entity that hopefully, if their volunteers had time to help us modify things or change things, you know, it really wasn't the best way to go. So by going with a conning, you know, a professional vendor, there's, you know, they produce these generators, and industry-wide uses their generator for some purposes, many purposes. You know, you kind of have you've engaged an expert who will continually sort of review financial theory and make sure that things that ought to be hanging together, you know, just kind of give you a much more robust, you know, comfort level that there's someone looking at this, and you know, kind of, you know, you're comfortable with what they're producing. So NAIC will then be, NAIC staff is charged with developing a set of 10,000 scenarios every month. The first day of the quarter, they'll produce this. Conning will provide ongoing maintenance. They produce many tools, many analysis tools for folks to say, well, are we comfortable that the scenarios you've generated sort of meet some expectations, you know, that they're, again, thinking back to when the first field test, there were a lot of negatives that we thought was unreasonable. So we've put kind of a limit on, well, we shouldn't expect really negative rates, and we shouldn't expect them to go negative and stay there a long time. So there's a kind of validation in statistics that sort of look at that. There's much more robust documentation around the conning generator than was with the Academy. Conning will provide training, and I think NAIC is probably offering up some of that as well, and just kind of the overall support. So, you know, I think it's pretty logical that this is, you know, a much better approach than what we had before. So the next steps. There's some things to kind of wrap up now that we've sort of adopted GOES for reserving. That was important to get done by this past summer, because then it made it into the valuation manual. When that gets adopted by exec and plenary at the summer meeting, it becomes effective for the next year. So starting in 2026, companies will be required to use the generator. Some other sort of extras that tag along, particularly of interest, is the C3 Phase 2 RBC instructions. Let's try to describe this, and I hope it doesn't get a little complex, but when you're using the old Academy generator, actually we're going to go back a few years. Again, Academy generator was developed in the 90s, was used for a while. In around the early teens, it kind of become to the realization that generator and just the overall variable annuity requirements, reserve and capital requirements, were just not functioning as they ought to be. There was some issues with, you know, the extent that, you know, companies that maybe were doing good risk mitigation, was doing good hedging, they were holding higher reserves than companies that weren't, and it, you know, it kind of offered odd incentives in the market, and that was identified, and the NAIC sent a group after it, and the Variable Annuity Issues Working Group, they studied the issue. They engaged Oliver Wyman, so you might remember hearing of the Oliver Wyman VA Framework Project. I will say that Oliver Wyman did say, hey, the Academy generator is not good to be using going forward, and I think regulators agreed, but they said, I just don't want to tackle that right now. That's too much, and it turns out, I think it was a good call, because, you know, who knows how that would have played out. But kind of getting a framework in, they needed to sort of modify the calculation of C3 Phase 2 to reflect that the Academy generator was not very robust. So they were really focused on the most, you know, say 2% worst in the tail scenarios, rather than, I described that 95th percentile. They were really much deeper in the tail than that, because the Academy generator just wasn't robust enough. So fast forward to today, we have this, the RBC requirements that talk about that sort of CTE 98, or the 2% worst focus. We've got to adjust that, because we've now got a generator that does a much better job of providing, you know, tail scenarios, or, you know, good identification of risk when things get bad. So anyways, that is being studied right now by the Life RBC Working Group and the VA Capital Reserves subgroup, and there's an exposure that will end Friday this week, and will be talked about. There's some more work on the documentation. I think both the NAIC and Conning are working on that to kind of streamline it and make sure that it's kind of like any project. You do a lot of work on things, and it's like, oh yeah, we've got to go back and do the documentation of this. NAIC will produce scenarios. It's sort of the first time, I don't say go live, but it's kind of they will go ahead and produce scenarios for 10/1 of next month on the 1st. So companies, and they can kind of run themselves through the process to kind of see what do we run into, what does it meet the requirements. I think we'll learn a lot once they start producing this a few times and kind of see what hiccups maybe they run into. And then model governance. This is probably a pretty big piece that's still out there. You have to sit back and think, well, the valuation manual requires, was put in there that with this new generator, it needs to be periodically assessed for continued reasonableness. And again, we've engaged Conning to be our expert. If they have expertise that, hey, there's some financial theory out there that you ought to be maybe looking at it a little differently than we are. I just think that the point of this model governance is that it's periodically reviewed, and that there's a structure around when we make changes and when we make those decisions. I think that ought to be the last one. So.
Thanks, Pete, for that good overview. I'm Amy Fitzpatrick. I'm an actuary at the NAIC, and I'm going to talk to you today about what is new with VM22. First, I'll go through a little bit of the history. We'll discuss a little bit of formulaic versus principle-based framework, which Pete did a little bit of an overview for me, so we might skip over those a little bit. And then a brief overview of the adopted framework and the subgroup's next steps. So I have a shortened history here that starts in 2024, but our story actually begins many, many years before that. I'd say a big milestone was 2020 when the American Academy of Actuaries provided a preliminary framework for this principle-based approach for fixed annuities. And from there, the regulators and interested parties worked together to come up with a framework that by the time we got to 2024, it was ready to test. And so Ernst & Young and the Academy of Actuaries pulled together the participant results from companies that volunteered to run this framework with some of their non-variable annuity blocks. And then in the spring of 2025, they actually presented that to the subgroup. And just a plug, if you go out to the VM22 subgroup webpage, you'll find the full results of that presentation, which I have a link in this slide deck. Then, just like Pete said, it went through the formal NAIC committee adoption process this spring and was adopted at the NAIC Summer National Meeting. But our work isn't done. So we have work this fall to continue to work on publications like the Life Annual Statement. We're adding a VM22 reserve supplement similar to what we have for VM20. And we also have some topics that were tabled that were maybe not as high priority for initial implementation and required additional discussion and maybe research that we're going to look at for 2027 valuation manual. And then I also wanted to include the effective dates here. So we have this optional implementation period for 2026 through 2029 where contracts issued 1/1/2026, companies can start using this new framework, but then by 1/1/2029, those contracts would then be required to apply this principle-based framework for those products that are in scope. Okay, so just to get you a little bit of information on what this field test results look like, and I see one of my colors did not show up. It looks okay when you print it, but it does not show up on this screen. So I have the participant mean in that blue that blue bar. The light blue bar is the participant median change from the CARVM formulaic approach to the VM22 principles-based approach. And then that black bar is the model office results. What you can't see is I have one standard deviation above and below the mean, but I also have that on the next slide that's in table form. So as you can see, the payout category, we had participants send information information on their structured settlement contract results, the single premium immediate annuities, and the pension risk transfer. You can see that there were some decreases for the SPIA and pension risk transfer and some mixed results for the structured settlement contracts. And then you can see under the accumulation category, there were increases for those fixed annuities that had no withdrawal benefits, and then you see some decreases for the fixed indexed annuities with withdrawal benefits. Let me go on to the next slide. So this is just a table of the prior information. The one thing to note about this is, one, this was the framework that was slightly different than what was finally adopted. One of those is the additional standard projection amount. That was included in these VM22 final reserves, but that is a disclosure only item in the adopted framework. And then a few other tweaks were made to some of the assumptions. So that's something to just keep in mind when you're looking at these results. The range of participant change, we didn't want to, breach confidentiality. So this is the range from the maximum change minus the minimum change from that change to VM22 PBR. And then we also included the number of participants in each of those categories, just to give you some context. And that link below is from our NEC website. It'll take you directly to the PowerPoint deck that has all of these results. Okay, and Pete did a good job of doing this for me a little bit already, so I'm going to go over it really quick. This is just a formulaic versus PBR, and just boiling it down, the formulaic is a one-size-fits-all, and the assumptions are locked in at issue. And then under the principle-based reserving, companies are then able to use their own experience to the extent it's credible, and then those assumptions are updated regularly. So then going into comparing CARVM to VM22, I have a column there for CARVM that just talks briefly about, the prescribed interest rates were locked in at issue and you had to use prescribed mortality, and just this oversimplification of the methodology. You're using a worst case scenario, essentially. And then under the principles-based framework, you're using the generator of economic scenarios data, and those interest rates vary from valuation date. Then the companies are using their own experience to the extent it's credible for their lapses in mortality and expense assumptions. And then the other thing, like Pete mentioned, was you're using for the stochastic reserve the 30% average of those worst case scenarios rather than the worst case. But under both approaches, you're having some sort of conservatism baked in there. Under CARVM, it's the prescribed method, and under PBR, you've got prudent estimate assumptions where you have some margins in your assumptions. And in the basics, you're having a minimum reserve being held under each situation. So why are we switching to principles-based? Well, Pete hit on one of those. It's consistent with the existing framework. We have life insurance on principles-based, and variable annuities are. The next logical extension would be non-variable annuities, especially considering the evolution of products over the last several years. We have hybrid products and a lot of optionality on those guarantees. It's also pretty streamlined to update the valuation manual. Before, if any of you have been involved in opening a model regulation, it's a bit of a time-consuming and complex process, and having it as part of the VM is a lot easier to update as they need to evolve and adapt with the market. Another big area is there's been a lot of pension risk transfer activity, and pension risk transfer is one of the products that are in scope, and as we've seen, those can be very large transactions, very material. And then the other reason is cross-border reinsurance. That's been a pretty hot topic, and I encourage you to look at the data from the AM Best presentation yesterday that gives you a little bit of idea about, how many insurers are we looking at, and you can see that there's a pretty good chunk of that is the non-variable annuity business. But there's some challenges. So switching to principles-based, that means there's a lot more work for company actuaries. They have assumption development, and there's advanced modeling and professionalism that they are going to have to comply with. And it's also extra work for the regulators. They have more work to review these and benchmark those assumptions and make sure, does the principles-based framework still work like it should? I think the regulators have done a really good job of doing these reviews, and they have these processes in place for VM20 and VM21 reviews that you're leveraging those processes and learning from other regulators that have already done this. Okay, so now we were talking a little bit about the conditions for exemption. Now, there are ways that some companies may not be subject to PBR, and I've outlined The two key ones here that are listed in section 2 of the valuation manual, the first one's based on size. If a company has less than $1 billion in exemption reserves, and if they're part of a group, if that group has less than $2 billion in exemption reserves, they may be exempt. Those exemption reserves, I have a slide in the appendix that actually outlines how that's defined. And then the other option is, maybe it's a company has a block of non-variable annuities that's in runoff, and there looks like they have new contracts, but it's actually due to election from existing contracts that were valued under VMA and VMC. It might be that those aren't subject to VM22. And then in either case, those contracts with living benefits are not allowed to be exempt from PBR, but in general, those companies are going to be asking the regulators, can we be exempt from this? I'm not going to go over these two examples, but I have an example here and one on the next slide that we've gotten these questions pretty often on what happens when a group has under $2 billion in premium, but I have a company that has over $1 billion, who's subject? And then the same thing with, okay, my group has over $2 billion, but what about my little companies that have less than that billion? Are they subject to PBR? And so these slides outline that and where you can go in the valuation manual to find those. The principles I'm going to go over just really quickly. This is what you can think of as the foundation of how VM22 was drafted. These are the 5 core principles listed in section 1B of VM22. And the main one, the first one is, you're quantifying a statutory reserve to meet the obligations in light of the risks. And 2, that calculation is based on projected asset and liability cash flows. That third principle is you're developing a model and you're going to be describing that model and disclosing those decisions. Fourth is we know that there's a limitation between real life and modeling those real world risks, and that disconnect needs to be reflected in your model. And then the fifth, which I find really important, and I think that there's a great example in the valuation manual, and that is your model consistent with these principles? Is there a reason why maybe you're modeling something that's reducing your reserve, but it's not reducing the risk? So there is some specific instances outlined in the VM22 Principle 5. Okay, so now getting to the good stuff. So what is in scope of VM22 PBR? I'm going to start with the out of scope, because if it's not a variable annuity and it's this other annuity, it's going to fall under 2 different sections. It's either under VM22 or it's under VMA, VMC, and VMV. So that out of scope, you see your guaranteed investment contracts, your synthetic GICs, your stable value contracts, and funding agreements. The one I didn't mention on here, and it is explicitly listed in the valuation manual as excluded, is pre-need annuities. And then I've listed all of your other kind of non-variable annuity contracts that you could think of, and then kind of what reserve category do they tend to fall under, and that applies to both group and individual annuities. So next steps for the group. The subgroup's going to continue to look at the publications and make recommendations for changes to the life annual statement. We have the new VM22 supplement, reserve supplement blank, as well as there'll be some changes to Exhibit 5 to add some labels for VM22. Tomorrow, we're going to be discussing the SPA disclosures for APF 2025-12. That's to refine those disclosure requirements. And then we have a future meeting where APF 2025-13, we're going to be discussing how would we retroactively or retrospectively apply this to contracts issued since the valuation manual was first adopted? How would that work? And then finally, we're going to look at some topics that were tabled from the prior discussion. So just to give you some links to additional resources, if you go into the slide deck or PDF that they have online, you can go to our NEC website and stay abreast of what VM22 is doing. If you're a regulator and you want to join the distribution list, you can do that through NEC Connect. Or if you're an interested party, you can email me your contact information, and then I have a link there to go to the adopted APF. Thank you, and here you go, Fred.
Okay, thanks a lot. Excuse me. Amy just walked through the process for developing an initial reserve amount, and Pete mentions the access that state regulators have for asset adequacy analysis filings through the valuation manual, section VM30. So this work and the reviews of this work help ensure assets are adequate to pay future claims in various scenarios. And if the assets are not adequate, additional reserves are typically held. But what's going on is for around $1 trillion of recent annuity transactions, the assuming company does not file a VM30 memorandum. Therefore, this policyholder protection can be lost. So AG 55, Actuarial Guideline 55, requires companies to provide asset adequacy testing to state regulators related to certain treaties. A big part of AG 55 is testing the reserve actually held for adequacy and the adequacy being based on transparent assumptions. There's an understanding that assumptions underlying reserves actually held may be appropriate, even if they're using assumptions less conservative than those required under U.S. statutory reserve requirements. Many companies are using reinsurance such that the total reserve held after the transaction is closer to an economic reserve than the U.S. statutory reserve, such as CARVM or VM22. So an example of this is that for annuities issued through 2025, if a policyholder had an option to take lifetime income with a present value of $120 or a cash value of $100, U.S. statutory requirements say that you had to assume every policyholder selected the more valuable lifetime income. But there's evidence that many policyholders select the less valuable cash value. We think that VM22 is going to help correct a lot of this. But with that being said, if reserve adequacy is achieved only with overly aggressive assumptions, so there may be some cases where companies get overly aggressive in assuming asset returns, policyholder utilization of product guarantees, or have aggressive mortality or longevity assumptions, then that's a cause for concern. It's possible that some companies are appropriately undergoing transactions such that the amount of reserves supporting a block of business is lower than U.S. stat. However, it's also possible that some companies are going overboard with assumptions that are too optimistic. So from our standpoint, whether reserves are adequate using appropriate assumptions is important for state regulators to know when the reserves and supporting assets are impacting U.S. insurers and U.S. policyholders. I'm doing a bad job going through the slides, but there we go. Okay. So here's an example of information we're trying to find out. Many insurers are investing in more illiquid assets to support annuity liabilities, and this tends to lead to some questions. One is, are expected returns and moderately adverse conditions reasonably assumed from assets? Are risks of those assets appropriately reflected? For instance, are there reasonable scenarios that trigger asset losses for riskier assets? Are these scenarios included in reserve adequacy testing, especially after a reinsurance transaction? Or are reserves potentially too low in some of these scenarios? And maybe most importantly, would U.S. regulators know that this under-reserving is happening? So with all this in mind, we created at LATIF AG 55. At first, we started with some goals. One was to provide U.S. state regulators what is needed to review reserves and solvency of U.S. life insurers. Number two, to steer clear of conflict with reciprocal jurisdiction and covered agreement issues. And thirdly, to help prevent work by U.S. ceding companies where there's immaterial risk. There was a lengthy public process to develop the concepts and wording in the guideline. We worked several issues out with industry. One is the scope is fairly limited for AG 55. The requirements only apply above a certain size and relative impact threshold for the seeding company, and if the assuming company does not submit a VM30 asset adequacy memo filing to states. Also, the guideline is disclosure only. This is another issue worked out with industry. The guideline does not say that if cash flow testing results are negative, the company needs to hold additional reserves. Companies are still allowed to make that determination, and domestic state regulators continue to be allowed to work out reserve expectations with their companies. But the agreement is that any NAIC coordinated findings that may indicate a need for action will go through a new public process that may involve revisions to the guideline down the road. It's unknown at this time if that will be needed, but this was part of a negotiation in part to help ensure the guideline could get adopted this year, which it now has. Another thing worked out with industry is the allowance of a similar memorandum. We've had discussions with industry members that provide other materials, perhaps similar to a VM30 filing, to other jurisdictions. There are criteria for companies to be allowed to do this, and it's possible that they would need to include supplemental information if the similar memorandum route is taken. I'll now walk through key parts of AG 55 regarding the scope. AG 55 applies when the assuming company does not provide a VM30 filing to a state. Also, when the treaty contains over $5 billion of reserve credit or MODCO adjustment, or for smaller treaties that are still significant for the seeding company. So for instance, if a treaty has $500 million of reserve credit and $500 million is more than 10% of the seeding company's total gross reserves, that treaty would be in scope. But with these criteria, it also excludes a lot of treaties. Another part of the guideline are expectations for analysis resulting from the guideline. So for a treaty in scope, cash flow testing is expected in most cases. This means a projection of asset and liability cash flows over multiple scenarios. There are some exemption possibilities for treaties that would otherwise be in scope. So going back to thinking about how the guideline was developed, a main concern was reserves being reduced below U.S. stat, potentially to inappropriately low levels. Many affiliated treaties have reserve reduction as a main goal, but there was an observation that there are some non-affiliated treaties with this goal, but perhaps have many other goals, mainly focused on risk transfer. So where we ended up kind of in the negotiations is that for non-affiliated treaties with low risk, there was an identification that perhaps there are a lot of protections in place to ensure reserves are not reduced too much. So the guideline contemplates an opportunity for the seeding company to request exemption from the domestic regulator with coordination with the NAIC group I lead, which is called the Valuation Analysis Working Group, or VOG with a V. So VOG is charged with working through asset adequacy issues for life insurers and will be performing reviews of these filings. Another aspect of the guideline is attribution analysis. This will also be provided in most cases. So this will show each of the reasons for reserves going down in support of a block of business. It will show how much of the reserve decrease is due to differences perhaps in mortality, perhaps policyholder behavior, or due to differences in asset return assumptions between what they would, potentially assume here or in another jurisdiction. We also recognize there are other reasons, and we're kind of working through the attribution analysis chart with industry at the current time. So we think this attribution analysis will be a key in evaluating the reasonableness of the new lower reserve that's being held. So regarding the cash flow testing, here are some details on what's expected to be performed. So as background, In the absence of reinsurance, a U.S. life insurer would typically hold reserves according to U.S. statutory requirements, minimum capital and surplus to ensure the company is above risk-based capital action levels, and an excess multiple of minimum capital and surplus for added protection in a bad scenario, and oftentimes to attain certain ratings from rating agencies. So cash flow testing involves testing just the reserves for adequacy. So this exercise helps ensure reserves are adequate to cover moderately adverse conditions. Then there's added comfort that minimum capital and excess capital are available in case of a more severe interest rate mortality or mass surrender scenario to ensure that policyholders will still get paid. So with offshore reinsurance, it gets a little more complicated. Different jurisdictions may have different systems for measuring solvency. A reserve may have a different purpose than it does in the US. So for this reason, a company may perform a mandatory run and an alternative run of their cash flow testing for AG 55 purposes. The mandatory run tests the adequacy of the reserves held in total by the ceding and assuming companies. The optional alternative run may test a higher amount for adequacy. This higher amount is only appropriate if there is excess capital not included in cash flow testing that's available to handle severe events. So our goal is to test an amount for adequacy in moderately adverse conditions and separately be assured that there's an additional amount that can handle beyond moderately adverse events. So these reports will first be due on April 1st, 2026, reflective of reserves being held for year-end 2025. Like with Actuarial Guideline 53, it can be a standalone document or a clearly documented section of the VM30 Actuarial Memorandum. The report will contain information on treaties, cash flow testing assumptions and results, the attribution analysis, and identification of risks. The guideline is officially adopted by the NAIC as of last month, but there are still discussions at the Life Actuarial Task Force on templates that will contain certain filing information in a standard format. Like with Actuarial Guideline 51 for long-term care, Actuarial Guideline 53 for complex assets, VOG will perform reviews and coordinate with domestic regulators. And that leaves us 2 minutes for questions and answers, I believe.
Thanks for the presentation. Any thoughts on, with the adoption of VM22 for non-variable annuities, if there's going to be less of an incentive for companies to move reinsurance offshore or to captives?
I think there's a belief there will be less incentive, but not removal of incentive. I think we've kind of been schooled over the past few years about, maybe a few months or several months, about, you know, maybe 4 or 5 reasons that companies tend to go offshore. It could be for access to foreign capital. It could be for a variety of reasons. It's not just to get out from the reserve requirements. We think that is one of the drivers in many cases, but not the sole driver.
Okay, I guess thank you all for attending and enjoy the rest of the conference.